Welcome to this explainer. Today, we are tackling literally the biggest question on investors' minds right now. Does the classic three-fund portfolio actually still work in 2026? Look, for decades, this strategy has been the absolute bedrock of passive investing. But let's be real, the financial landscape is shifting incredibly fast. So we're going to dive right in, using 10 years of cold, hard performance data to rebuild a modern, optimized strategy specifically for 2026. We're going to break down exactly what works, what definitely doesn't, and most importantly, how you can position your wealth for maximum growth moving forward. To really grasp why we need to update this strategy, I want you to picture this. Imagine two investors. They both started with the exact same $100,000 10 years ago. Now, investor A diligently followed the classic three-fund portfolio. The exact one that practically every financial guru tells you to use. Investor B, though, they made a slight pivot. They swapped out just 3 low-cost ETFs to create what we're calling an adjusted 2026 version. Keep in mind, they both put in the exact same effort, made the same monthly deposits, and spent the exact same amount of time managing their accounts. Well, that one simple change, just tweaking those 3 boring low-cost ETFs, created a staggering $140,000 difference in their returns over a decade. Seriously, just think about that for a second. We're not talking about gambling on crypto or chasing risky penny stocks. We are talking about basic, everyday ETFs anyone can buy right now. 140 grand is a completely life-changing gap. I mean, that's a kid's entire college tuition, or maybe 5 extra years of early retirement, literally all generated just by optimizing a classic strategy for modern markets. Okay, Section 1, Rethinking the Growth Engine. In the classic portfolio, your growth slot usually relies heavily on international stocks to act as this big diversification engine, usually favoring funds like Vanguard's VXUS. And hey, on paper, that makes total sense, right? Invest outside the US, spread your risk globally. But you've got to see this glaring performance gap. If you dropped your $100,000 into VXUS 10 years ago, it grew to about $156,000, which is roughly a 9% annualized return. It's not terrible, but it's not great either. Now, what if you swap that for a U.S. large-cap growth fund? That exact same 100 grand in Schwab's SCHG delivered roughly a 19% annualized return, rocketing to about $465,000. And if you went with QQQ, tracking the NASDAQ 100, it hit a 21% return, turning your initial investment into over $600,000. But wait, to be totally impartial here and look at all the data fairly, we have to talk about the international caveat. A lot of analysts just gloss right over this. In 2025, international stocks had a massive run, returning over 32%. So for the very first time in a decade, they actually beat U.S. stocks. The takeaway here, dropping international exposure completely is a pretty big bet, not some mathematical guarantee. Smart investors don't just ignore international markets forever because of past U.S. outperformance. They weigh the data and understand that global economic cycles do eventually rotate. Even with that recent international bump, SCG is absolutely still our primary growth engine pick for 2026. And the reason is twofold. First up, it has an ultra-low fee of just 0.04% a year, which means a lot more of your money actually stays yours to compound. Second, it gives you much broader diversification than something like QQQ. It's way less dangerously concentrated in just those top 10 tech giants, while still reliably pumping out that roughly 19% annualized return over the last decade. Now, if you really want that pure NASDAQ exposure, QQM is a fantastic runner-up since it has a lower fee than the standard QQQ. Moving right along to Section 2, the Great Bond Myth. For literally decades, the golden rule was, when stocks go down, bonds go up. They were supposed to be the ultimate financial shock absorber, but recent history just proved that this old rule has some massive hidden flaws. In the brutal 2022 market crash, the classic safe pick, Vanguard's Total Bond Market Fund, BND, completely failed its one job. While the S&P 500 dropped 18%, BND had its absolute worst calendar year in history, falling 13.11%. Think about that. The exact asset investors trusted to protect them during a crush actually lost more money than some equity funds did that year. It was a massive wake-up call. And this perfectly illustrates why you can't just panic and blindly swap all your bonds for a safe dividend stock fund like SCHD. It's crucial to understand the type of crash you're actually in. In the 2022 interest rate crash, SCHD was a rock, dropping only 3.3% while bonds fell off a cliff. But rewind to the 2020 COVID liquidity crash, where everyone panicked and sold everything. SCHD plummeted 33.4% right alongside the S&P 500, while BND barely flinched. The reality is, bonds and dividend stocks protect you against entirely different flavors of disaster. So for 2026, SCHD is your primary income layer. It yields a really nice 3.22% and has 14 straight years of dividend growth under its belt. It's a phenomenal fund. But, and this is a huge but, since zero interest rates are officially a thing of the past, bonds are actually paying out again. Because of this, if you're over 50, you absolutely need to bring BND back into the mix. With BND now yielding a solid 4 to 4.5%, it's your true structural crash insurance for the exact kind of downturns that a dividend fund simply can't handle. All right, Section 3, building the solid foundation. We need an anchor for this whole strategy. And honestly, this is the part where most people wildly overthink it and paralyze themselves. Your foundation is just your core market exposure. It tracks the broader economy without trying to be fancy. You can confidently pick either VOO, holding the 500 largest US companies, or VTI, which holds about 3,600 US stocks. Why? Well, they both cost practically nothing, a microscopic 0.03% fee. And those top 500 companies make up about 85% of the weight in both funds anyway. They're virtually twins, both handing you nearly identical 15% annualized returns over the past decade. Just pick one, set it, and forget it. Section 4, Age-Based Portfolio Blueprints. Okay, so we've got our 2026 funds picked out. VOO or VTI for the foundation, SCHG for growth, and SCHD plus BND for income and safety. But having the right funds is only half the battle, right? The secret sauce is the allocation, how much goes where. That depends entirely on one number, your age. Let's look at a guy named Kevin. He's 34, has a 30-year runway to retirement, and invests $500 a month. Because he has decades to ride out the market's roller coaster, his blueprint is aggressive. We're talking 40% in VOO, a massive 35% in SCHG for pure growth, and 25% in SCHD to get that income snowball rolling early. Assuming historical 15% returns, this setup is designed to turn his $500 a month into over $3 million. Now let's meet Patricia. She's 48, right in her peak earning years and sitting on $280,000 saved up. Patricia still needs a lot of growth, but she needs a bit more balance too. Her blueprint shifts to a 45% VOO foundation, pulls growth back a bit to 25% in SCHG, puts 20% in SCHD for income, and crucially, she brings in a 10% slice of BND. That little 10% bond allocation is her safety net, protecting what she's already built from sudden liquidity shocks while still letting her wealth grow aggressively. Quick aside here, there's a brilliant tax hack for Patricia in 2026, and really for anyone in her shoes. It's called asset location. She should totally keep her dividend-heavy SCHD tucked safely inside her Roth IRA. The limit is $7,500, but if she crosses 50, it jumps to $8,600. That way, all those constant dividend payouts are growing 100% tax-free. On the flip side, she can keep SCG in her regular taxable account because growth funds are naturally tax efficient. They don't generate much taxable income until you actually sell them. Finally, we have James and Linda. They're 62, just 3 short years from retirement, and they've got a fantastic $650,000 nest egg. The job of their portfolio has fundamentally shifted. It's not about hypergrowth anymore. It is entirely about surviving a market crash without panicking. So their blueprint features a hefty 20% slice of BND as pure crash insurance, 30% in SCHD for serious income, 40% in VOO to outpace inflation, and they've dialed SCHG way down to just 10%. To put that into perspective, let's run the math on their $650,000. That 30% SCHD allocation is $195,000. That slice alone is throwing off roughly $6,270 a year in passive dividends. And historically, that payout grows every single year. Plus, they can bulletproof their retirement even more by taking advantage of the huge new 2026 401k super catch-up limit, which is $11,250 for ages 60 to 63, and keeping 1 to 3 years of living expenses strictly in a high-yield savings account, paying over 4%. As we wrap up these blueprints, if you take nothing else away from this explainer, I want you to write this down. Growth builds your wealth. Income protects your lifestyle, and safety protects your sleep. Understanding the very specific job of each of those 3 buckets is literally the dividing line between successful lifelong investors and the ones who panic sell at the absolute worst time. Which brings us to our final point. Section 5, the ultimate investor trap. Before you go logging into your brokerage to revamp your whole portfolio, we urgently need to talk about this trap. It quietly and totally destroys even the smartest investors trying to execute this exact strategy. It's the 10-year historical bias trap. If you just look at a chart and dump all your money into whatever did best over the last 10 years, without understanding the difference between a liquidity crash and an interest rate crash, you are setting yourself up for disaster. Look, the market of 2014 to 2024 is not the market of 2026 and beyond. So I'll leave you with this. Will you use this data to intelligently build a protected portfolio for tomorrow's reality? Or are you just going to blindly chase yesterday's returns until the next crash wipes you out?